This liquidity trading strategy is going to make any trader a profitable trader very fast. It does not matter if you're a beginner or a pro trader that is already making something out of the market. There are many liquidity strategies out there, and you must have tried out a lot of them. But they are not just giving you those level of profits that you really want from the market. In this video, I will be teaching you a liquidity strategy that a lot of pro traders are using, but they will never tell you. And no, this is not one of those confusing setups that you see all the time. And you don't even need to do a top-down analysis before using this strategy. With just one time frame, the setup, and some extra pro tips that I will be showing you in this video, you will begin to see yourself making easy profits daily from the market. If you skip any part of this video, you are going to be making this simple strategy a very hard one for yourself. Each part of this video is as important as every other part of this video. So my tribe soldiers, let's get down into this business. There is no way that I am going to start this strategy without telling you guys how important using the trend will be. When trading this strategy, the problem a lot of traders have with liquidity is sometimes not actually the act of using the wrong setup for their trades. The major problem lies in the conflict of their trading setups with the market trend. And just like many strategies that I have taught in this channel, liquidity setups are to be also traded with the trend. Many traders will confuse you and tell you that liquidity does not work with the trend, and you should only focus on the structure. But the truth is that the only way to trade liquidity and make profits is to trade them along with the trend. The markets will only move up or down after clearing out the liquidity from the traders who traded against the overall movement of the market, or the traders that were not patient enough to wait for the right time to enter a trade according to the overall trend of the market. Follow me carefully. This will begin to make a lot of sense when we start trading the strategy. There are only two traditional trends in the markets, the uptrend and the downtrend. Every other one is a pause in between the trends. The uptrend starts like this and the downtrend starts like this. In an uptrend, the institutional traders focus more on taking out the orders of the sellers before making a strong price movement, while in the downtrend, the institutional traders will focus more on taking out the orders of the buyers before making a strong price movement. The market behaves this way because it needs a very large influx of liquidity. And if you don't know what liquidity actually is in the market, I have made a video that will guide you through in all the basics of liquidity concepts from level 0, and you can check that out after the end of this video. So in this example, we can see that the market was moving in an uptrend, and then it started making some significant price movements, which was different than the previous market movement. Now, watch this. As this price was moving, you can see that the market started creating liquidity zones from the activities of the retail traders. Some of these trading activities, which includes stop-loss orders from the sellers who thinks the market is still going down, and from the buyers who think the market has finally started moving up. The both of them are wrong, because one is selling based on ignorance, while the other is buying based on lack of patience, or maybe because he does not understand how liquidity works. So the market will come down and sweep all the liquidity, and then starts going up finally in the right direction. This is going to be part of our strategy, but first, there is something that we cannot leave behind when analyzing a profitable liquidity setup. This is what we must wait for, even before waiting for the liquidity sweep. In simple terms, we call it the break of structure. The break of structure represents a new shift in the market from the current trend to a new trend. For example, if the market is moving in a downtrend and all of a sudden the market breaks a structure, that is, taking out the last lower high, it signals that the buyers are beginning to make some moves against the sellers, and we can then begin to look out for buying opportunities, buy setups and buying signals. And when the market is moving in an uptrend, and as the market is moving in higher highs and higher lows, then the price begins to move up and take out the last higher low We can then see that movement as a signal that the sellers are making moves against the buyers to take them out and begin to fall massively. So after the break of structure, we begin to look out for sell opportunities, sell setup, and selling signals. All these concepts will begin to make a lot of sense when I start using them in our strategy. You will see how I am going to piece them all together to make it work greatly, so we can all make a lot of profits from the market. The last thing we must understand again, when you see liquidity sweep zone, you cannot enter a trade in the market only because you saw a break of structure in the market. This is the point where the institutional traders are always waiting for their trades. They don't want to enter at the beginning or get caught up in the middle of the range. They're always patient and targeting the last move of the market before the market starts making great price movements. After the market has taken out a lot of liquidity, they do what we call today as the sniper entry. Just like a patient hunter, patiently aiming and targeting his game till it's the right time to make a shot. And there goes a big win. So now, let's begin to arrange all these concepts together and see how we are going to turn them into a golden strategy. So first of all, we must make sure we are moving in a trending market. So now, if we identify a trending market, just like this one, which we can see that the market is moving in an uptrend, we want to see the price retracing after making a new higher high, and at the same time, making short-term downtrend moves as it retraces. These short-term lower highs and lower lows signals the weakness of the sellers as they make their short-term market movements before the buyers will take over again and start pushing the market up in great volatility. As long as the retracement does not move below the last higher low of the uptrend structure, we are still in safe hands to find a buying opportunity, and none of these short-term lower lows and lower highs will mean much in the market. So as the market is making those little downtrend movements, the next thing we will be looking out for is a break of structure. This is where it gets interesting. We want to see the market boldly breaking the last lower high of these short-term downtrend movements. At this point, we know that something is about to shift in the market. We know that the buyers are beginning to gain strength to enter the market and to begin to make rally for another higher high. So that is number 2. Remember that number 1 is to identify the overall trend of the market. And now we have number 2, which is to wait for a break of structure. Now, what is number 3? The truth is that the market will not start moving up immediately after a break of structure. It begins to make moves that will manipulate a lot of traders, especially those that are following this short-term downtrend moves on a lower time frame, and also take out as many orders as it could before moving in the right direction. So you want to see this little liquidity movements inside the range of the setup, which could be in the form of tiny ranges or tiny trending movements inside the range. These are part of the liquidities that the market will take out before moving in the right direction, and it will be step 3. So step 3 is for you to wait for liquidity movements within the range of the setup. You are going to write these steps in a piece of paper and place them in front of your computer or on your phones, so you follow them daily, accordingly, and never make a mistake with them. Actually, they look very simple, but they are very effective when applied. We have 2 more steps to apply to this, and these steps are the most important part of the strategy. After you find these liquidity movements in the ranges, you will draw a horizontal line at the beginning of the break of structure. This is the point where the market will take out the last point of liquidity before moving in the right direction. This is exactly where the institutional traders are taking their trend continuation trades, and many traders don't know this and can't see it, because the moves of the big games are very quiet and subtle, that you won't know what's happening until the market starts making strong price movements on the chart with a lot of volatility. But I have prepared a solution for that. In fact, I will give it to you for free. There is a way we can identify their game movements even before the market begins to move in strong price action. and we can only do that by looking into it and employing a strong candlestick pattern, and we call this candlesticks pattern an engulfing candlestick. This candlesticks is very important because it shows us that the buyers have completely engulfed the sellers and have taken full control of the market, and that is a good sign, as that is what institutional traders actually do. They take full control of the market and then start moving the prices. When we see this engulfing candlestick pattern, after the market had taken out the last liquidity, then it's time to enter the trade, placing your stop loss below the momentum candlestick, and you'll take profit target at the last higher high of the uptrend, and then allow the market to do its thing. Now, I will show you another example of this in a downtrend structure, but before that, let's take our time to review these steps one by one, as that is even more important. So number 1, we identify the overall market trend. Number 2, we wait for a break of structure. Number 3, we identify the liquidity movements inside the range. And number 4, we mark the last liquidity spot and wait for the market to take out all the liquidity, including the last liquidity, and then form an engulfing candlestick pattern. And after that, we are good to take our trades. Now let's see an example of this in a downtrend. When you look at this chart, you can see that the market is moving in a downtrend. And how do we know? Because it is making a series of lower highs and lower lows. So now, we have identified the trend. The next thing we noticed is that the market made a retracement move, which was made up of little uptrend moves, making higher highs and higher lows. And then here, we had a break of structure, breaking the last higher low. And that means we have our second step confirmed. And after that, we see the market began making liquidity moves within this price range, creating a loss of liquidity that the market will then wipe off, in line with our third step. And finally, here we have the last liquidity zone that the market will take out before finally making the strong falling price movements. And so you draw it out, and when the price finally returns to the liquidity zone, you watch out for a bearish engulfing candlestick. And when that appears, just like this one, you take the trade, placing your stop loss above the engulfing candlestick, and you'll take profit target at the next lower low. And here you can see that the trade went very successful, as we followed our 4 steps carefully and did not break them. And now that you have known this setup and this strategy, you will begin to be able to spot a lot of them on your chart easily. Because this setup shows up almost every time on the chart. But here comes the plot twist. If you start seeing this setup way too much, and every time on your chart, it means that you are getting the setups wrong, and you are not following the steps that I laid out for you. More examples of this strategy in action include trades like this one, and this. And if you are not yet clear on this strategy, then you will have to watch this video multiple times until it begins to sink down into your memory. This strategy is simple but very effective when you start trading it. But before you start trading it on your real account, do well to backtest it multiple times on your demo account or your backtesting softwares in order to master it and gain more confidence trading it. This strategy works on all time frames, but don't go below the 5 minutes time frame when using this strategy. And if you are not clear on some of the basic liquidity concepts which I was talking about, or you don't know what liquidity really means in the market and the different forms of liquidity, this video will teach you all the basics of liquidity. Don't forget to subscribe to our channel and join us on Telegram for free trading signals. We are the Trading Tribe, and it's a wrap for this video. See you in the next one.